This is the luxury world. Get inspired with us today and tomorrow. For decades, the Rolex Submariner held a revered position in the luxury watch world, not just as a timepiece of exceptional craftsmanship, but also as a seemingly foolproof investment. It was widely accepted that one could acquire this horological icon, enjoy it for years, and still command a profit upon resale. That widely held assumption, however, no longer aligns with present-day market conditions. In today's economic environment, acquiring a Submariner as a financial asset may be considered more of a speculative risk than a sound investment. In today's video brought to you by the Luxury World, we will be providing you with a critical examination of market behavior, pricing data, and economic fundamentals, which reveal a sobering truth. The Submariner's once impervious reputation as a stable store of value is now in question. For those who have not yet subscribed to our channel, doing so will ensure access to upcoming insights and content that can further refine their watch investment strategies. The historical narrative surrounding the Rolex Submariner has been one of steady upward momentum. From its modest beginnings in the 1950s as a tool watch priced at approximately $150, the Submariner evolved into a globally recognized symbol of prestige and achievement. As its popularity surged across generations, so too did its market value. For years, it appeared that ownership was synonymous with automatic appreciation. The mythos of this model was further amplified during the post-2020 boom, when the global luxury watch market experienced unprecedented levels of growth. However, this surge was not driven by organic demand but by a perfect storm of economic stimuli, social media-driven speculation, and opportunistic flipping. The period between late 2020 and early 2022 represented an unsustainable peak in the Submariner's secondary market pricing. Fueled by pandemic-era stimulus payments, record low interest rates, and a surge in speculative interest, resale prices ballooned. At the height of this frenzy, in May 2022, the average secondary market price for a standard steel Submariner soared to approximately $18,889, nearly double its retail value. However, what followed was a swift and punishing correction. As monetary policy tightened and liquidity dried up, the Submariner's pricing collapsed by 31%, erasing much of the speculative gains accrued during the boom. While a modest recovery has occurred since, the assets have settled into a far more subdued pricing environment. The trajectory now resembles a plateau rather than an incline. This correction was not an anomaly. It was a reflection of underlying economic shifts. The notion that Rolex timepieces, and the Submariner in particular, could function as a hedge against financial downturns has been resoundingly challenged. The Submariner's value appreciation proved to be highly dependent on favorable macroeconomic conditions. When central banks reversed their accommodative policies to combat inflation, raising interest rates and constraining consumer spending, demand for luxury goods sharply declined. Disposable income was reallocated to essential expenditures, and enthusiasm for high-end timepieces diminished. What was once viewed as a haven asset was revealed to be a fair-weather holding, vulnerable to broader economic contractions. Beyond macroeconomics, the regional dynamics of demand have further contributed to the decline. In the United States, the post-pandemic stimulus-fueled consumer wave quickly receded. In China, high youth unemployment, a weakening property market, and restrictive luxury import policies dampened consumer confidence and significantly impacted demand for aspirational items such as Rolex watches. This reduction in demand across key global markets signaled a new phase in the Submariner's market behavior, one that no longer guarantees upward momentum, but instead reveals a volatile and economically sensitive asset class. On the demand side, significant changes have been observed. The so-called Rolex waitlist, often portrayed as a months-long queue driven by overwhelming demand, was in fact a loosely enforced tool used by authorized dealers to manage and prioritize prospective buyers. The illusion of exclusivity, sustained by opaque allocation practices and selective communication, contributed to the mythology of scarcity. However, data from 2023 to 2024 suggests that this illusion is no longer holding. The average wait time for a Submariner dropped dramatically, from 105 days to just 60. This change reflects not greater accessibility, but rather waning interest. As resale premiums dwindled, so too did the ranks of speculative buyers. Without the promise of immediate profit, many flippers and opportunistic collectors abandoned their place in line, exposing the soft underbelly of demand. On the supply side, Rolex has been quietly but deliberately expanding its production capabilities. Although the company remains famously secretive regarding exact figures, industry experts estimate that roughly 150,000 Submariners are manufactured annually. While that may still qualify as limited when compared to mass-market products, it falls short of justifying the extreme price premium seen in previous years. Moreover, Rolex's strategic investments in manufacturing infrastructure suggest a long-term plan to increase output even further. A new production facility in Bull, Switzerland, expected to become operational by 2029, is the most visible sign of this shift. The brand's intention is unmistakable: reduce the gap between supply and demand to rein in speculative pricing and regain control of brand equity. In effect, investing in a Submariner today is a wager against the manufacturer's explicitly stated goals. As Rolex continues to scale production, secondary market premiums are likely to face sustained downward pressure. The foundation of scarcity, which previously underpinned the investment case, is no longer structurally sound. Insurance presents another unavoidable expense. Standard homeowners' policies often fail to provide adequate coverage for high-value watches. As a result, specialized watch insurance is typically required. This coverage usually costs between 1% and 2% of the watch's appraised value annually. Over a decade, insurance on a $15,000 Submariner can total approximately $2,250, a recurring cost that delivers no investment return but is critical for risk mitigation. When the time comes to divest, additional costs are incurred through the sales process. Watches are highly illiquid compared to other asset classes. Rapid sales typically require engagement with a dealer, who may offer 10 to 20% below market value to protect their own margins. Selling via online platforms or private channels involves platform fees, authentication services, shipping expenses, and exposure to transaction fraud, all of which can consume 5% to 15% of the sale proceeds. These frictional costs represent a significant drag on net returns and further undermine the viability of the Submariner as a financial instrument. When these costs are compiled, the financial picture becomes far more sobering. For a Submariner purchased at $15,000 and held over a 10-year period, insurance expenses total roughly $2,250, and one standard service adds another $1,100. Combined, these carry costs equal to $3,350. To simply recoup this amount, the watch must be appreciated by more than 22%, excluding inflation, opportunity cost, or resale commissions. The net investment threshold is therefore considerably higher than most buyers anticipate. This is not an indictment of the Submariner as a product. On the contrary, its status as a design icon and marvel of mechanical engineering remains undisputed. It continues to represent a pinnacle in everyday luxury and tool watch functionality. The Submariner's historical significance, robust construction, and enduring aesthetic make it a treasured addition to any watch collection. However, conflating exceptional craftsmanship with reliable financial return is a misstep. A watch may be a masterpiece to wear, but that does not make it a masterpiece to invest in. What the data suggests is clear. The Rolex Submariner can no longer be considered a low-risk, high-reward acquisition. Market volatility, declining speculative demand, increasing supply, and the compounding cost of ownership have all undermined its status as a blue-chip, horological asset. The conditions that once enabled consistent appreciation, scarcity, exclusivity, and unrestrained demand have eroded. What remains is a luxury item that should be appreciated for its intrinsic qualities, not its hypothetical returns. In conclusion, a pivotal question now arises within collector and enthusiast circles. Should the Submariner be regarded solely as a symbol of horological heritage and refined personal taste, or is its investment allure permanently diminished? For those seeking historical continuity, legacy craftsmanship, and daily wearability, the Submariner remains a distinguished choice. But for those pursuing financial gain, the evidence suggests that the investment bubble has indeed deflated, and the path forward must be approached with a far greater degree of caution and realism. What are your thoughts on the Rolex Submariner that we featured in this video? We would appreciate it if you let us know by leaving a comment and giving it a thumbs up. Do not forget to follow our channel for more content. Once again, this is the Luxury World, and we look forward to having you join us in our upcoming videos.